The proportionality principle is acknowledged at international level and is one of the fundamental criteria for the rulemaking of European Commission and other several European agencies. Before explaining what can be considered the main challenges in applying the proportionality principle, it is worthwhile to give a clear definition and to have a better understanding of what proportionality is and how it can be defined. We will consider a twofold definition, from a legal and an economical point of view. The legal definition of proportionality is stated in the fifth article of the Lisbon Treaty. We can summarize the proportionality principle with three concepts: suitability, necessity, and proportionality in stricto sensu. Necessity, because European regulation must not exceed the limits of what is appropriate in order to attain the objectives needed by the legislator. Suitability, in the sense that it should be chosen the least onerous measure between the several available, and proportionality in a narrower meaning, since disadvantages caused must not be disproportionate to the aim sought. From an economical point of view, the concept of proportionality can be summarized with three words: effectiveness, in the sense that the regulatory measures should have a real impact in problems that they will have to tackle; efficiency, in the sense that the effective purpose must be achieved with the lowest possible costs; and finally, economy, it is considering if there might be potential wider costs for the economy as a whole. It is possible to identify 5 milestones that found the principle of proportionality. Objectives, so the cost-benefit analysis; materiality; totality of regulation; excess complexity; and differentiation. The cost-benefit analysis consists in evaluating if a new regulation designed to address market failure implies more or less costs than the failure that is addressing. The main issue linked to this aspect of proportionality is that evaluating costs and benefit of a new regulation is not always an easy task, and sometimes it is almost impossible. Materiality can be thought as a particular case of differentiation, in the sense that consists in applying a regulation only to those institutions which are relevant to the issue addressed by the proposed regulation. So, according to this principle, it is important to include in regulation waivers for some classes of banks with an automatic trigger. According to the principle of totality of regulation, it would be necessary to evaluate the broad impact of the totality of regulation on the system. It is clear that correctly identify costs and benefits of an additional regulation in this huge perspective is an hard task. What applies to individual regulation does not necessarily apply to the regulatory regime as a whole. One of the reasons behind this phenomenon is the economic concept of diminishing marginal returns of regulation. Indeed, as we can see from the chart, marginal costs of regulation rises as the total amount of regulation increases, while marginal benefits of regulation start to decrease after a certain peak. The optimum would be to impose regulation until marginal benefits and costs are equal. Modern finance is complex, perhaps too complex. Regulation of modern finance is complex, almost certainly too complex. As you do not fight fire with fire, you do not fight complexity with complexity. The excessive complexity of regulation is a strong weakness. Indeed, it might have quite important drawbacks, as excessive cost of compliance that may also be disproportionate between small and large banks, the imposition of barriers in the system leading to a lack of competition, and finally a regulatory arbitrage, since more complex rules are more difficult to assess. The principle of differentiation is expressed in recital 46 of the CRR, According to it, it is necessary to avoid the one-size-fits-all approach that may be very detrimental, especially for small businesses. In order to avoid this problem, it is important that every regulation takes into account differences between banks, considering classes of them according to systemic significance, size, business model, and risk profiles.
Let's now consider a specific case to see the principle of proportionality in action, the implementation of Basel III. First of all, it is a voluntary regulatory framework on bank requirements. The EU has implemented it with the Capital Requirements Regulation of 2013. Albeit the third Basel Accord was thought to be applied only to systematically relevant banks, the EU application has extended it to all banks. This, however, has been done in line with the principle of proportionality, explicitly mentioned in the regulation. For example, calculation of capital requirements for trading exposures is simplified if an institution has respectively on and off balance sheet trading book business less than 5% of total asset, 5 million euros, and less than 6% of total asset and 20 million euros. Reporting is reduced to less frequent intervals, or to less detailed information for some institutions. Discrimination is based on factors such as size, material exposure, and investing firms. The technical standards on own fund differentiate on the basis of the business model. They apply specific requirements to cooperative banks. In particular, the fourth set of technical standards relates to the preferential and multiple distributions non-joint stock companies. These institutions may determine large exposures limit if the institution has eligible capital less than 6,000 million euros. This limit, however, must not exceed 100% of the institution eligible capital. The European Commission published on the 23rd of November 2016 results of its call for evidence on the EU regulatory framework for financial services. In this proposal, it mandates the EBA to produce a report on the compliance burden of reporting. It requires the EBA to develop an electronic compliance tool to assist institutions to identify the prudential rules that are applicable to them, and finally introduces an increased set of proportional and specifically targeted rules. The exemption for small trading book business is amended with a larger nominal value of 50 million euros, and the calculation of the trading business does not include exposure to foreign currencies and commodities. The addition of a mid-sized trading business definition for banks whose trading book consists of no more than 10% of total assets and 300 million euros. Such business can calculate risk-weighted assets market risk with Basel 2.5 approach. Disclosure is subject to whether the bank is considered a large, small, or non-listed institution. Large banks have to fully comply with Basel III, whereas small and non-listed institutions are subject only to selected annual disclosure. Large institutions included G and D, SABs, and institutions with at least 30 billion euros of assets. Different methods for calculating the exposure value are stipulated, depending on specific measures. An institution shall use the simplified method if the size of the on and off balance sheet derivative position is equal to or below 10% of the institution's total asset and 150 million euros. Banks with derivative position not exceeding 5% of total asset and 20 million euros may use the original exposure method.
As already said, cost-benefit analysis constitutes an important tool in order to reach proportionality. In this section of our presentation, we focus more on the relationship between CBA and proportionality. Every financial regulation, when implemented, implies some benefits, which are the central purpose of the regulation itself, but also some costs, which need to be well managed. In general, we can say that among the benefits, we include the reduction of probability of financial failures that may cause terrible effects to the economy and a higher degree of confidence in bank safeness. The costs, instead, fell in first instance on the financial institutions and are related to the mandatory risk management and the reporting requirements. When considering proportionality, strong emphasis should be put on CB analysis. Proportionality, in fact, requires the net value of CB analysis to be positive. If we take a deeper look to the costs originated by the regulation, we can affirm that they are highly dependent on how the authorities define the core risks. In addition, an absence or an incorrect application of proportionality in this domain may cause distortions in the financial system. Since the cost of regulation tends to have scale effect, small institutions may suffer higher costs rather than the larger ones. Moreover, the scale effect may encourage mergers and acquisitions, influencing the organization of financial institutions, and it may be an obstacle to enter in the market for the insurgent institutions. In last instance, customers and employees may pay the biggest part of this cost if financial institutions are reluctant in diminishing their margins or they have problems in increasing their productivity. A well-done cost-benefit analysis, in accordance with the respect of the proportionality principle, should always consider these distortions and represent the point of view of the customers. To conclude, we can say that the application of the proportionality principle in financial regulation should be focused on the achievement of the targeted objectives and should rely on a correct use of cost-benefit analysis. Some recommendations have been done by the EBA banking stakeholder group in order to contribute to an extensive and efficient application of the proportionality principle. Here, a list of the more important ones, according to our opinion. First, more flexibility on future level 1 rules should be introduced in order to adapt the legislation to particular cases. Secondly, regulatory institutions should promote the creation of ex-ante and ex-post review groups. Ex-ante by creating a semi-autonomous review groups within regulatory institutions, and ex-post by encouraging the spread of independent and private review groups. Finally, cost-benefit analysis should be applied considering the totality of the regulation and not only individual regulatory requirements. This is the end of our presentation. Thank you for your attention.